So for down payments, that's a very important part of the process now. You should plan on, if you're buying a car, car's typically the second largest investment or purchase that you're gonna make in a short amount of time. Usually your home is the biggest one, then your car, because it's based on pricing and what car values are today, is usually your second largest. So you want to plan for that. You want to save up money for down payment. Down payment helps with lowering that depreciation and how that car may depreciate for you. And you can do that with cash. You can do that with a trade. So if you paid on your car enough and you know what the NADA used value of your vehicle is, you may have equity built into your car, and that may be used for down payment as well. Just remember that when you go to the dealership's probably going to give you the rough trade estimate of your vehicle and not necessarily what the true value of your vehicle is. So you want to know what that is up front so you know that you're getting a good deal with that. Sometimes a direct sale to a private individual is a better way to go. Instead of trading in your vehicle, you can do a private sale, and sometimes you'll get more money for that. You'll get the true value of your vehicle. You can go to certain dealerships will go ahead and buy your used vehicle from you, whether or not you purchase with them or not, and you can get better deal with that in selling it that way. So there's a couple different ways you can come up with your down payment. Cash is always one option and the best option, but there are other ways to do that if you don't have that resource available to you. So you should always want to avoid negative equity. Negative equity is where you owe too much on your vehicle versus what somebody's giving you for your vehicle, whether it be the NADA clean trade value of that vehicle, selling it outright. You want to avoid that because now you're financing in debt from another loan of a vehicle that you no longer own into your new car. And that's going to affect your loan to value ratios. That's going to affect possibly your debt to income ratio. So you may not qualify for this vehicle anymore if you sold it outright and didn't have any negative equity. You may avoid that. It may affect the interest rate that you're earning because your credit score will change a little bit. So there's a lot of variables on why you should avoid negative equity. The best thing to do is to either sell it outright and get more, or put that in part of your plan, right? I'm gonna pay this down, I'm gonna make some principal reductions on my next car payment. It may be an extra $50, it may be an extra $25 a month, but you'll slowly bring down that negative equity and reduce all that.